Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, we're going to be analyzing Centene Corp stock, ticker CNC. This one was back on my request board, and it fell 40% today. So I thought it would be a good time to make a video since I'll probably have more people asking about it soon. As always, this is not individual investing advice, just how I analyze stocks. So, spoiler alert, I bought a little bit of this one today. And I'm going to explain why in the video. So in my last video, I went over some of the returns from the ideas that I've shared here on the channel, along with the weekly picks that I have on Patreon. If you haven't checked those out, I have a free tier on Patreon too, if you want to check that out. But the weekly picks have been doing really well. So if you get a chance, you might want to check those out. But one of the things that I said was I was going to try to have at least one buy idea every 2 months for free on YouTube. Even if there wasn't anything that was like, perfectly at my buy price. I would just, if 2 months go by, I will find whatever the best thing happens to be, which is how I do the weekly picks. So I figure if I can make 8 weekly picks in 2 months, I can surely toss the folks on YouTube a bone and share a buy with them as well, because my YouTube ideas have been very, they kind of come in waves, and then there's nothing. And then there's like in April, there was a whole bunch. And then before that, there was hardly any. So I'm going to try to even some of that out a little bit to give people a better idea of kind of, how my processes work and how they perform. So this is double duty because someone actually had already asked me about it. So Centene, let's see here if I have description. So healthcare insurance company, basically. So they do Medicaid managed care, ACA, Obamacare plans in 29 states, Medicare programs, but Medicaid and ACA are probably the biggest sources of revenue for these guys. So what happened was the Senate passed the big beautiful bill. I think I don't know. I heard they were going to rename it, but I don't know if they did or not. And part of that was cuts, basically, it sounds like, to Medicaid, which was one of their big programs. And then they also announced that they were pulling guidance for this year's earnings. And so that freaked the market out, and they sold the stock off 40%. So 40% is a big move. And I've been very cautious with these health insurance companies. I owned a couple of them. I trimmed both of them several months ago. I still own a little bit, but there's stock like Humana, which has fallen a lot as well. You can take a peek at that one, actually. And they all have small differences between them, but in general, they're kind of in the same category. So we see earnings kind of fell off a cliff for Humana. I've been very patient, didn't buy the dip, even though I'm monitoring it, which has been a good idea because it's still going steadily lower here. I'm not sure how far off the peak. It did have a big drop similar to Centene's here. So it's 54% off the peak. And let's get back to Centene. And where are we off the peak here? We are 65% off the peak price. Now, the idea behind behind buying it here, and it's just a small position, like a 0.5% portfolio weighting. So just kind of a nibble here is that whatever troubles they're going through, the market is probably could be overreacting to. And if the market is overreacting to it over the next 3 to 5 years, then we should, maybe sooner, but these things can take time, especially if politics is involved. So maybe the government changes the funding in 3 or 4 or 5 years. Well, the market will probably anticipate some of that coming, and the stock price will probably change before then. But when everybody dumps and there's no buyers out there, and something falls 40% and is back down to where it was in the 2016, like almost 10 years ago, that's enough to kind of take a good look at it. So when I do, basically what I've done is I've compared it to the 2009 recession. So I have a technique that I use to help me give me at least some metrics, so you're not just going on feelings when stuff like this happens. So because you could have bought this, after this first 30% or whatever this was, right? 35% decline, right? That's a pretty big decline. But it wasn't anywhere near like a recession level valuation. Now, almost certainly these earnings that FastGraph are showing are going to be worse. They're probably going to look like Humana's, where they just fall off a cliff. I don't know where they're going to bottom, but back in 2016, they were around $2 a share. So, and we're at 7, so they could fall 2/3 and kind of be at the same levels back here. Of course, the direction will be wrong, that investors like to see. But what I'm going to do is I go back to 2008 and 9 when there was a big drawdown. I look at what the recession PE was. So I created this metric. It's very basic. You use the peak earnings, which is 48 cents here, and then the low price during this time, which was $3.77 in 2009. And you create a PE ratio out of that. So if you do that, I think it's 7.85. So PE. That's basically the most pessimistic PE that you could pull on this stock over the past 20 years. So, and what happens is if earnings fall, so I'm for now when I do that calculation, I'm actually using, let's see if I guess I don't really need to move my head here. I'm going to use these $7.17 earnings from last year. So I know that this $7.30 probably isn't going to happen. It might be half that. And that's what the market is pricing in right now. Some sort of them getting crushed over the next, say, year and a half. I don't know how long these kind of plans run, but if they need to be like renewed and there's no money there and people don't have it, blah, 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 we could see these 2026 earnings be 2/3 lower is pretty much what the market's pricing in. So that's a huge decline. But I'm going to base this on the $7.17 earnings from 2024. So those are already baked in. That's going to be the peak for whatever happens. They already made this money. It's not going any lower. And I'm going to compare that to that peak 48 cents. I think the next year was actually 49, but the stock price had already started rising a little bit by that time. And it's just 1 cent difference. So I'm using this 48 and I get a 7.85%. I call it the recession PE. That's this number right here. Okay. So often when I'm doing this, I add like 30. Well, if it's a 7, if it's that low single digit of a PE, often I'll add like 40% to it. Because I don't usually expect a business or the stock to get just as cheap as it was in 2009, especially healthcare stocks, because they were really cheap back then. Because again, we had a total freak out with Obamacare. Now, obviously, this is a different, there are always different situations, but it's nice to have some sort of a guide. So at least you're kind of referencing something. Again, and that keeps you from buying earlier when the stock was down like 35% and looked like a good deal. I can look back in time and say, well, it can get worse. And basically it got exactly as worse as it was in 2009, just using this basic method. So normally I don't expect things to get as bad as they were then. So I just want to get like a good price. And if it's within 40% of that very pessimistic recession PE, then that's usually enough for me to come in and buy it, especially if it's a really low PE, like a single digit one like this. So normally I'm willing to pay even more of that. So with this one, given all the things we don't know and how bad it's going to be, I took that buffer out. So we're looking at exactly what it was doing in 2009 based on peak earnings and low price. Okay. So there's that's me being extra conservative. And the other way I'm conservative is I also added 65% to the stock price when calculating the PE because of debt, basically. So you have a 65% difference, at least. It might be a little more after the stock price declined today, but I don't care so much about that final drop. It will influence this because the market cap will usually fall faster than the total enterprise value. So the total enterprise value is like the business plus all the debt and other obligations and stuff they might have. So that's actually 65% higher than the market cap. So I assume, look, we're buying it. If you want to buy it all and be as most negative as possible, throw the whole thing in there. I didn't go back and look what their debt was in 2009, but let's say they didn't have any then, but now they have more, right? This would take that into account as well. So I took that into account as well to be even more conservative on my buy price. And when I put that all together, is pretty much as conservative as I could possibly be if you assume they eventually recover from this over the next several years. Even if earnings come down and bottom, assuming they can start growing again after that and they can come out of this over the next, like I said, 3 to 5 years or so, then the buy price is like $34.11. And so we're just barely there. We're right there, right at the edge. And so once I went through the whole thing and I was as conservative as I could possibly be, I said, look, you might as well take a chance on this one. It looks like the market's like super negative. Now, the market could be right. This bill isn't even passed yet. The House has not passed it. There could be changes still. Maybe there'll be even changes in favor of more funding if there's enough pushback from the representatives. I don't know how that's all going to shake out. Seems like the more conservative members are the ones more likely to try to kill the thing or, prevent the passage. But we'll see. I mean, politics can be weird sometimes. There's going to be other members who maybe have a lot of people on Medicaid in their state, in their district, who are going to be directly impacted by stuff like this. So, and they might not. They might just draw their own line in the sand. Personally, historically, when stuff like this happens, the people spending the money win. So if it's a question of getting it passed and spending the extra money and then just promising to grow your way out of it with either tariffs or economic growth, that's almost always what happens. I mean, we're in a weird political time, so it's hard to say for sure, but that's kind of the bias. So we could get positive changes right away. We could also just have the businesses adapt once everything's actually in law. They see how it's working. They can find ways to adapt and maybe go from there. Maybe working more with states. It's hard to know, but you have to wait and see how it all works out, and it takes time. But that's what businesses usually do. They're usually able to adapt at least somewhat. And then, again, we have elections in a year and a half, and then in another 3.5 years. And that sounds like a long time for a lot of investors. But if you're a medium-term investor who's normally investing in these timeframes anyway, it's possible people feel the damage from this, and it changes their, personally, when it's not just like theoretical, and they vote differently, right? So that's possible that could change in a few years either. So I don't know what's going to happen, but I'm putting out some scenarios to just show that theoretically, like, things might not be as bad as the market is pricing in. It's also possible earnings just don't bottom as low as the market thinks. It looks to me like the market's pricing in a 65% drop in earnings, something like that, 65%, which totally could happen. But it might not. The market could be off by what if earnings only drop 40% and then they start recovering the next year, right? That's totally possible, or in a couple of years. That will probably allow the stock price to creep up, I would think, based on what I'm looking at now. Just at a very high level, quick, boom. This looks like what the market's thinking. And 40% moves are big one-day moves when you're already down 40%, right? So that kind of can place the odds in your favor too. So I have kind of the recession PE metric that's guiding me, really just to help me try to get closer to potential bottoms like this, or not buy too early, which is what everybody's done, let's say, the past couple of years. So it's patience, patience. You're always kind of monitoring to see how bad things could really get. But when you get something like this, you don't want to put your life savings on it, but putting a little bit of money here when these opportunities come, 4 out of 5 times, usually I do pretty good. But there will be disasters too. So, I mean, you just want a strategy that kind of takes that into account. If you have a decent system, place your bets accordingly. I usually try to make them pretty evenly placed most of the time. And as I showed in my results in the last video, that will work over time, even with a lot of stocks, if you have enough good strategies to work with and you focus on like the medium term. So that's my case for buying a little bit of Centene Corp, even though I'm pretty cautious on this whole sector right now, industry right now. When you get this kind of a dive, you can't, some people think I never buy anything, right? Because I'm always like, it's not cheap enough. It's not cheap enough. Well, it's always scary when it's cheap enough, So taking small positions sometimes can also help you just have the courage to say, look, it's bad. It looks like it's going to be bad. Everything looks bad. But if it's not really bad, then I can make some money here. So that's my buy for Centene Corp. I bought a little bit today. Don't plan to add probably too much to it, especially in the near future. I'd be more likely to spread future bets around. And we'll see how it goes. I'll follow it up next quarter and let you guys know what the returns are looking like. Okay, thanks for watching, everybody. If you found this useful, hit the like and subscribe video. And I'll see everybody later.